Good morning, everyone, and welcome to another edition of Your Daily 5 presented here on StockCharts TV. I'm your host for the show. My name is Grayson Roze, Vice President of Operations here at StockCharts.com. Always wonderful to be with you for an episode of Your Daily 5. I always like to mention this is one of my favorite shows that we do on StockCharts TV. Just a different perspective every day, always something interesting, always fascinating charts from great technicians. It's always fun to catch up on this one, especially being a little bit of a shorter format at the end of the day there. So glad to be with you. It's been a little while since I've hosted Your Daily 5 here, but we're going to have some fun taking a look at some of the things that I am watching in the markets, some of the charts that have caught my eye. So without further ado, let's get into it. First up, this is actually a bit of an update on a chart that I put on the last time that I was on Your Daily 5. So I call this stoplight shading, and the idea is really simple. You set two price levels on any chart that you're watching. Anything above the top price level is the risk-on zone. That's the green zone. That's where we're happy and we are partying. Now, anything down below the lower price bound is the red zone. That is the danger zone. That is where we are unhappy. We're worried about what's happening, and we want to be out of whatever the security is that we are looking at. In between those, you have the neutral zone, and that is what we shade in yellow. So just like a stoplight, green means go, red means stop, and yellow means, hey, slow down, be careful, watch what's going on, pay attention. So the last time that we put up this chart here, this is, by the way, VTI. This is the total U.S. stock market. This is one of the benchmarks that I use really for everything, but also a great benchmark because you can actually own it. You can go out and buy this ETF. It's not a pure index that you actually can't trade. So this is one of my key measures. Again, the entire U.S. stock markets. When we put up this chart, we say kind of what's happening. Well, the last time that we put up this chart on the show, we were down pretty deep in that danger zone, pretty deep in the red zone. We have bounced. We've bounced off those October lows, and we are back up towards the top of the neutral zone. This chart was actually taken this morning, so we are pulling back a little bit after yesterday's hot session, but we are deep in the neutral zone now and approaching that risk-on territory. So this is a key chart. Now you can argue about kind of where these levels should be. You can move those lines up and down. But the key is, I love the sort of the concept behind this chart. You know, think about your charts in this really, really simple kind of view. Are we good to go? Are we hitting the gas? Are we on the brakes? We're sitting there at a standstill, or are we somewhere in the middle? We're kind of fluctuating between. We're sitting in the neutral zone and being cautious. I'm still cautious about this market. We have bounced higher. It is great to see. We're seeing some rotation into more kind of growthy risk-on corners of the market. That's also great. We're going to talk about that in a couple of minutes. But still, we are coming off a huge down year, so we are still in what I would call kind of the neutral zone, being a little bit more risk neutral than full-on risk on. So that is the update here on the stoplight chart for VTI. Now, next up, we're going to look at something a bit more sort of obscure, something you might not look at every day. This is the Value Line Arithmetic Index, and what it represents is the average stock. We call this index the average stock. What is the average stock out there doing? Now, if you're looking at an index like VTI or the S&P 500, obviously those are cap-weighted indexes, so you're really going to be weighted towards some of the big companies in the market, the big dominant market cap companies. So when we look at the Value Line Arithmetic Index, we're kind of taking some of that out of the equation, and we're looking at what is the average stock doing. Well, in this case, we actually look even a lot better than VTI. You can see that the average stock has cruised above this downtrend. We saw this downtrend really since November of last year. We broke through that, came back down to actually test it, and now we have rocketed higher above there. We are approaching some new highs here in for the average stock. This is great to see. This does get me pretty excited because if the average stock is working, that's actually more important than something like the S&P 500 working in theory, because you're looking at a broader collection of stocks. Now, we do have a really nice intermediate term uptrend here. The 50-day, you can see, is cruising higher. That is a nice rising 50-day. The 200-day, which is the thick green line, is flattening, but I would say still kind of pointing lower. So again, I'm still a little bit cautious here, but I do love to see the move that we've made here in the average stock index. Now, this is pretty stretched, so I am worrying about us pulling back a little bit here. we have moved pretty quick, pretty fast. So something I'm keeping an eye on there. But speaking of working, one of the corners of the market that has really been working, especially off of those fall lows, is mid caps. Mid caps, as you can see, this is an 18-month chart. That's what I look at, a year and a half. Mid caps have actually outperformed the total market by almost 9% over the last 18 months, over the last year and a half. You can see that not only have they outperformed, but we've also been moving higher, rocketing higher really here in MDY, and we're starting to take out some pretty important price levels. We're testing them right now, so we really do need to get through some of these levels and hold. But you can see this is actually what we call in ACP the last price reference line. So that dotted line going across, you can see where that is, where that kind of brings us back to some previous very, very important price levels. We're starting to get up to those points. We've broken that downtrend from November of last year. That's a beautiful thing here on mid caps. This is an area that I am watching closely. If you are looking for an area that's outperforming, mid caps may be one of the spaces that are doing it. Now, we do have that rising 50-day. I love to see that. But again, kind of a similar story. We've got a flattening 200, but not necessarily a 200-day that's pointing up. So I am watching for that. A little bit stretched again here, kind of just like we were looking with the average stock. But mid-caps, a space that has really, really been working lately. Now, speaking of mid-caps, one of the specific corners of mid-caps that's been working is revenue companies, the high revenue mid-cap companies. That is a space that has been absolutely crushing it. So again, we can weight indexes in any number of ways. We typically weight them cap weighted. We can do things like an equal weight index. We can do things like a price weighted index like the Dow. But there are all these other ways that we could spin an index. So what this ETF does, RWK, is takes the S&P 400, that classic mid-cap index that the S&P creates, that Standard & Poor's creates, and spins that, weights that towards revenue. So the companies with the higher revenue are going to get a higher weighting. Companies with lower revenue are going to get a lower weighting. On a revenue-weighted basis, mid-caps are absolutely crushing the rest of the market. You can see, again, over the last 18 months, revenue-weighted mid-caps outperforming by almost 19%. And perhaps more importantly, we are breaking out now to some new highs. We have actually reclaimed new highs for this index. We have cruised through those levels. We are a little bit extended, I will say, here on RWK, but this is a space and a fund that I'm looking closely at. This is, again, something that you can actually trade if it does pique your interest. A little bit stretched, would look for a pullback if you're looking for an entry here. But if this is a longer term position, this is a space that is really working and sort of an approach, a strategy that is really working here. We're actually seeing this as well with small caps and with large caps, the revenue weighted approach for both of those other indexes as well. Really crushing it. So an interesting little flavor there. You can look at RWK for mid caps, you can look at RWJ for small caps, and you can look at RWL for large caps. Now, of course, I always like to bring some ideas. This chart actually looks pretty similar to that mid-cap revenue-weighted chart that we were just looking at. But I am seeing a ton of strength coming out of all these different corners of the industrial space. We're seeing a lot of names in trucking, in materials and suppliers, and just all of these different industrial names really working. That's one of the sectors of the market that has been hot of late. Now, this fund, AIRR, American Industrial Renaissance, this fund has been breaking out to new highs. You can see again here on the 18-month view, outperforming the total market by almost 29%. This is a beauty of a breakout, a little bit stretched at this point. I'd be looking for more of a retest of that breakout and a bounce to see if we hold it. But moving averages all ticking higher. We've got new highs on price. We're working on new highs on price relative as well up here, comparing AIRR to the total market. This is a beauty of a chart, a beauty of a space, and we're seeing a lot of strength really throughout this space, throughout this sector. We're seeing tons and tons of industrial names making new highs. So that is one space that I am watching closely. Now, for more of kind of a risk on play, we talked about risk on, risk off, risk neutral at the beginning of the show. One other space that has been catching a bid is semiconductors. Now, there are tons and tons of different semiconductor ETFs out there. Some of the big ones are SMH and SOXX. Those have outperformed the market over this period generally. The kind of 18-month time frame, we've seen those groups, which had been incredibly hot, we've seen them actually give back a lot of their gains and actually underperform the market over this time period. Now, those groups are starting to move higher, and we're starting to see them actually outperform off the lows. But XSD is a really interesting one because, again, it's a semiconductors ETF. You can go buy this. But actually, over the last 18 months, this has held up much, much better than many of the other semiconductor groups that we look at, semiconductor ETFs that we look at. So XSD, you can see over the last 18 months, actually has outperformed VTI by almost 16%. Now, what we have is an ETF that has blasted off those October lows, is starting to reclaim against some key price levels, and is doing it while outperforming the market. This is beautiful. Now, semiconductors, obviously a little bit more of a kind of growthy risk-on corner of the market, but one that really is working. And if we think about making new relative highs here as well, if we drew a line across through basically from the start of 2022 right across here, we can see that this is breaking out to basically 12-month highs against the total market. So lots to love here in semiconductors overall, but XSD specifically is a really, really interesting chart that's caught my eye right now. So one to possibly add to your watch list. Anyways, I want to thank you so much for joining me on the show today for your Daily 5. Again, one of my favorite shows to host and to watch here on StockCharts TV, always something different. If you want to follow any of my work, you can obviously find me around StockCharts. You can also find my personal website, stockmarketmastery.com. Find me on Twitter. I'd love to catch up with you at Grayson Roze. Always love to bounce charts around with folks on Twitter there. And if you're into reading, you can pick up either of my books, Tensile Trading, the 10 Essential Stages of Stock Market Mastery, or Trading for Dummies. Little secret, we actually have a new edition of Trading for Dummies coming out very soon this year. So keep an eye out for that. But Trading for Dummies, the fourth edition, also a fantastic book as well. Now, one last thing, StockCharts in Focus is my show on StockCharts TV every Friday, 3 p.m. Eastern Time. We dig into the site, we dive into tools and features. Ultimately, though, what we're trying to do with this show is show you around StockCharts and help you get more value out of the site, the platform. So if you're interested in getting more out of StockCharts, learning more about how to use the tools, seeing what's new, getting some tips and tricks and things, if any of the charts that I put up today caught your eye and you're saying, hey, I wonder how you created that, well, check out StockCharts in Focus every Friday on StockCharts TV. We're always doing something different, always having fun there. Going to have a new episode this week on the sector summary tool, so keep an eye out for that. Again, thank you so much for watching. Thanks for tuning in to StockCharts TV and for checking out your Daily 5. I'll be back with you for another episode very soon, I'm sure. But until then, chart on, my friends.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.